Hello, I'm James, you're watching Accounting Stuff, and today we're doing a deep dive into financial statements. This is a special compilation video that I've split into 4 parts. First, I'll explain what financial statements are and introduce you to the main ones: the balance sheet, the income statement, and the cash flow statement. Then we'll explore each one in a bit more detail. We'll build each statement from scratch using a trial balance. Stick with me to the end and you'll be an expert on financial statements in no time at all. Let's do this. What are financial statements? Financial statements are reports that summarize the activities and financial performance of a business. They're prepared at the end of each accounting period, and they're designed to give investors and lenders a feel for a business's financial health. The 3 main financial statements are the balance sheet, the income statement, and the cash flow statement. Now I'll explain how each of these work with an example. Tealicious is a family-run business that produces a popular blend of black tea. Their financial year has come to a close and they've finished putting together their financial statements. So let's look at them. We'll start with the balance sheet. What is a balance sheet? The balance sheet is a financial statement that gives us a snapshot of a business's assets, liabilities, and equity at a single point in time. The balance sheet is also called the statement of financial position, and it looks like this. In the header, we have the business's name followed by the name of the financial statement. And directly below that, we have the point in time that we're looking at. A snapshot of December 31st. On the left-hand side of the balance sheet, we have a list of everything the business owns, its assets. And on the right, we have everything the business owes, its liabilities and equity. Tealicious owes liabilities to third parties like its suppliers, its employees, and the tax office. But it also owes equity back to the owners of the business. This includes their original capital contributions, which is the cash the owners injected into the business, and retained earnings, which are the cumulative profits that the business has held onto. If we collapse the balance sheet down into its core components, then we can see that Tealicious has total equity of $129.5 million. What does this mean? Well, if the business were to suddenly sell off all of its assets and pay off all of its debts, then in theory, this is how much money the owners would get. At the bottom of the balance sheet, Tealicious has total assets of $169 million and total liabilities and equity of $169 million. The stuff it owns is equal to the stuff it owes, so the balance sheet is in balance, which is fantastic news because a balance sheet always has to balance. Why? Because it says so in the accounting equation. Assets shall always equal liabilities plus equity. Or the stuff that a business owns is equal to the stuff that a business owes. What is an income statement? An income statement is a financial statement that summarizes a business's revenues and expenses over a period of time. If the balance sheet is a snapshot of a point in time, then the income statement is more like a video or a boomerang covering a range of time. The income statement looks like this. As you can see in the header, the income statement covers a period of time. The year ended December 31st. And in the body of the report, we have a summary of revenue earned and expenses incurred. If we collapse it, then we find that the income statement is really showing us 3 things. Firstly, Tealicious made $255 million in revenue, which is their top line income that it earned from selling products during the year. Secondly, it incurred $248 million in expenses. This includes the direct and indirect costs of running the business. And finally, when we subtract expenses from revenue, we see that Tealicious generated $7 million in net profit on the bottom line. Profitability is key to the income statement, which is why it's also called the statement of profit and loss. it tells us how much profit the business earned over a period of time. But be careful here, because profit doesn't necessarily translate to cash flow, which is why businesses also need a cash flow statement. What is a cash flow statement? A cash flow statement is a financial statement that shows a business's cash inflows and outflows over a period of time. Businesses need to make a cash flow statement if they are using accrual accounting. You see, there are two methods of accounting. We have the cash method and the accrual method. The cash method of accounting is often used by smaller businesses. It says that revenue is recognized when cash is received and expenses are recorded when cash is paid out. Under the cash method, the income statement and the cash flow statement are equivalent to one another. If cash comes in, we record revenue, and if cash goes out, we record an expense. It's nice and simple, but it has its limitations. What if Tealicious makes a large sale, but the customer doesn't pay the invoice until the following accounting period? Their revenue could be understated in the period that they made the sale and overstated in the following period when they received the cash. There has to be a better way, and thankfully there is. The accrual method says that we should recognize revenue as it's earned and record expenses as they are incurred when the substance of the transaction takes place. This means that cash inflows and outflows aren't equivalent to revenues and expenses. They need to be tracked separately in the cash flow statement. A cash flow statement looks like this. In the header, we have the period of time that it relates to, just like we had in the income statement. And in the body, we have two main sections. At the bottom, we have the opening and closing cash balances for the financial year. We get these numbers from the balance sheet. Tealicious started out with $11 million and finished up with $12 million. So overall, that's a net increase in cash of $1 million. But how did this come about? This is where the top section comes in. We work out the cash flow from operating activities, investing activities, and financing activities. Cash flow from operating activities covers regular business activities. How much cash Tealicious brought in and spent whilst selling tea. Tealicious is using the direct method, so this section mirrors an income statement prepared under the cash method of accounting. Cash flow from investing activities looks outside of the core operations of the business. These are the cash inflows and outflows from investments and buying or selling property and equipment. Cash flow from financing activities is all about funding the business, either through loans from banks or equity from the owners of the business. If we collapse this all down, then the net cash flow on the top should match up with the net cash flow on the bottom. It does here, which means the cash flow statement is reconciled. Let's do a quick recap. The balance sheet gives us a snapshot of a business's assets, liabilities, and equity at a single point in time. It shows us what a business owns and what it owes. It also tells us how much the business is worth to its owners. And then we have the income statement, which shows us a business's revenues and expenses over a period of time. When we take the difference, we can see if it made a profit or a loss. The cash flow statement reveals a business's cash inflows and outflows over a period of time. These are reconciled back to the movement in cash in the balance sheet. Before we go any further, you should know that I've put together cheat sheets covering all of these financial statements. I'll leave links to them down in the description. Okay, now that you've got a feel for financial statements, let's take a closer look at them one by one. We'll start with the balance sheet. A balance sheet, or a statement of financial position, is a financial report that gives us a snapshot of a business's assets, liabilities, and equity at a single point in time. Now, if you've watched my videos before, then you've probably heard this one. The stuff that a business owns is equal to the stuff that a business owes. In other words, a business owns assets and it owes liabilities to third parties. The difference between the two is called equity, which is what the business owes back to its owners. And so we have the accounting equation. assets are equal to liabilities plus equity. When we take a snapshot of this accounting equation at a single point in time, we're looking at a balance sheet. We'll call this one the basic balance sheet, and as its name suggests, it's got to balance. That means that total assets must always equal total liabilities and equity. A detailed balance sheet would look something like this. We expand out assets into current and non-current. Current assets are short-term assets, things like receivables and prepaid expenses. On the other hand, non-current assets are long-term assets. There are two main types, the ones that you can touch and the ones that you can't touch. We do the same thing with liabilities. Current liabilities are short-term liabilities, payables, accrued expenses and deferred revenue, and non-current liabilities are long-term liabilities, stuff like long-term loans. Equity, on the other hand, is a different kettle of fish. First, we have capital contributions, which is the money invested into the business by its owners. For a company with shareholders, we might call this common stock. And then we have the business's retained earnings, which are its accumulated profits held for future use. I do have a balance sheet cheat sheet which summarizes all of this, the links in the description. Anyways, how do you make a basic balance sheet? First, you need another accounting report called a trial balance. This shows us the closing balances for every general ledger account at a point in time. Here's a trial balance for a dating app called Tumble. It was run at the end of Tumble's financial year, December 31st, and it's an adjusted trial balance because all adjusting entries have already been posted. We can see all of Tumble's accounts and balances. Debits are on the left and credits are on the right. At the bottom, we can see that the debits total to $87,700,000, which matches the total credits exactly. This means that Tumble's trial balance is in balance, which is very important because if the trial balance is in balance, then the balance sheet also has to balance. Don't think I've ever said balance so much in my life. Accounts in a trial balance are usually arranged in a pattern. Above this line, we have the stuff that Tumble owns, its assets. And below the line, we have the stuff that Tumble owes, its liabilities and equity. We also have its revenue and expense accounts, which we used last time to make the income statement. So, how do we make a balance sheet? We'll start with the wrong way because this is a really easy mistake to make. And it goes something like this. We take all of Tumble's assets, liabilities, and equity accounts, and we pop them in their sections of the balance sheet. In theory, it's the right thing to do, but check this out. Total assets add up to $36,350,000, and total liabilities plus equity add up to $25,650,000. That's a difference of $10,700,000. So this balance sheet doesn't balance. What went wrong? We forgot to include Tumble's revenue and expenses. These are part of Tumble's retained earnings, its profits held for future use, which also sit in the equity section of its balance sheet. When we include them, total liabilities plus equity also add up to $36,350,000. So Tumble's basic balance sheet is in balance. Remember, the balance sheet is a snapshot of a business's assets, liabilities, and equity at a single point in time. On the left side, we can see what the business owns, and on the right side, we can see what it owes to third parties and its owners. How do we make a detailed balance sheet? We follow the same process. But first, we need to divide Tumble's assets and liabilities into current and non-current. Cash, accounts receivable, other receivables, and prepaid expenses are all current assets. Property, plant and equipment, and intangibles are non-current assets. Accounts payable, taxes payable, accrued expenses, and deferred revenue are all current liabilities. And long-term loans is a non-current liability. In the equity section, common stock is a type of capital contribution, and everything below that is retained earnings. These are Tumble's profits held for future use. Their opening retained earnings at the start of the year, less dividends, plus Tumble's net profit in the current year. And that's it. We can pick up all these numbers and put them in our detailed balance sheet. So we've got Current assets, $31,050,000 and $5.3 million in non-current assets. Current liabilities of $14.4 million and non-current liabilities of $1.2 million. Then we have $1,050,000 in common stock, which is a type of capital contribution. And finally, $19,700,000 in retained earnings or profits held for future use. Total assets are equal to total liabilities plus equity, so this balance sheet is in balance. Love it when things balance. Let's move on to the income statement or statement of profit and loss. What is an income statement? The income statement is a financial report that summarizes a business's revenues and expenses over a period of time. It works like this. If you take a business's revenue and subtract its expenses, then you're left with a profit or a loss. That's why it's sometimes called the profit and loss statement or the P&L, but we'll call this one the basic income statement. It's nice and simple, but it doesn't give us much information. We need to expand it out to see the full detailed income statement. At the top, we have operating revenue, which is the income earned from doing business, and then we take away any direct operating costs. These are the cost of sales, and that leaves us with a gross profit or a loss. Beneath that, we subtract any indirect operating costs or overheads to reach an operating profit or loss. And finally, we take away the indirect non-operating costs, things like interest expenses and tax, which brings us down to the bottom line, the business's net profit or loss. How do you make a basic income statement? The first thing you'll need is a trial balance. A trial balance is an accounting report showing the closing balances in all general ledger accounts at a point in time. Here's one for a dating app called Tumble. It's an adjusted trial balance, which means that all of Tumble's adjusting entries have already been posted. And it was run on December 31st, which happens to be the end of Tumble's financial year. This trial balance holds a complete list of Tumble's accounts and closing balances. Debit balances go in the left column and credit balances go in the right column. But how does this help us make an income statement? Well, we can start by drawing a line, because accounts in a trial balance are usually arranged in order. Above this line, we have Tumble's assets, liabilities, and equity. These are all balance sheet accounts, which we can ignore. We're interested in this stuff below the line, Tumble's revenue and expenses, which are their income statement accounts. The basic income statement is Tumble's revenue minus its expenses. In this case, they earned $60 million in revenue and incurred $50,350,000 in expenses. That leaves them with $9,650,000
in profit, baby.
But how do we make a detailed income statement? The method is pretty much the same. If we go back to Tumble's adjusted trial balance, then all we need to do is categorize their expenses like we did before. Cost of sales is a direct operating cost. General, administrative, selling, marketing, depreciation, and amortization are all indirect operating costs. And finally, interest and tax expenses are indirect non-operating costs. But please be careful with depreciation and amortization. If the long-term assets that they relate to aren't used in operations, then these would also be indirect non-operating costs. In this video, I'm assuming that they are used in operations. Right, that's the hard bit out the way. All we need to do now is lift these numbers out of the adjusted trial balance and put them in the corresponding sections of the income statement. That leaves us with a revenue of $60 million, just like before, less $17.5 million in cost of sales, which is a direct operating cost, which gives us a gross profit of $42.5 million. Then we deduct indirect operating costs to reach an operating profit of $10,450,000. And below that, we subtract the indirect non-operating costs, interest and tax, which leaves Tumble with a net profit of $9,650,000 on the bottom line. The bottom line is that we have one more financial statement to cover, and it's the cash flow statement. Come on, you can do this. A cash flow statement is a financial statement that summarizes a business's cash inflows and outflows over a period of time. We'll get into how that works in a moment, but first, why do we need a cash flow statement? In accounting, there are two main methods for preparing your books: the cash method and the accrual method. With the cash method, you recognize your revenue when cash is received and you record your expenses when cash is paid out. But under the accrual method, you recognize revenue as it's earned and record your expenses as they are incurred. So what does that mean? If you're cash accounting, then technically you only have one financial statement, the income statement. It summarizes your revenues and expenses over a period of time, leaving you with a profit or a loss. But with the cash method, we said that you recognize revenue when cash is received and you record expenses when cash is paid out. That leaves you with a net cash inflow or an outflow. So the income statement prepared under the cash method is equivalent to a cash flow statement. Keep that in mind, we'll come back to it later. Plenty of small businesses do their books this way, which is fine, but the cash method isn't allowed under IFRS or GAAP. If you're following either of these, then you must use the accrual method. So revenue must be recognized as it's earned and expenses must be recorded as they are incurred. In accrual accounting, we still have the income statement, but this time it represents what a business has earned and incurred, not its cash inflows and outflows. So it's not equivalent to a cash flow statement. So businesses using the accrual method keep a separate cash flow statement alongside their income statement, and they also keep a balance sheet which holds their assets, their liabilities, and their equity. What is a cash flow statement? At the start, I said it summarizes a business's cash inflows and outflows over a period of time. But what does it look like? We begin with the opening cash amount at the start of the period and compare it against the closing cash amount at the end of the period. You can find both of these numbers in the balance sheet. The movement between the two is the net increase or decrease in cash. And once we know that, then we can get onto the real purpose of the cash flow statement, explaining how we ended up here. There are three main sections: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Operating activities are the main revenue generating activities of the business. These are the cash flows involved in selling goods or services. Investing activities sit outside of the business's core operations. They involve the buying or selling of investments or other long-term assets. And finally, financing activities relate to funding the business through raising or repaying cash to third-party banks or the owners of the business. This, my friends, is the basic structure of the cash flow statement. Positive numbers represent cash inflows and negative numbers are cash outflows. Now, there are a couple of ways to make a detailed cash flow statement. We can use the direct method or the indirect method. We'll start with the direct method. Cash flow from operating activities under the direct method mirrors the income statement prepared under the cash method, which we saw earlier. At the top, we have cash receipts from customers, which mirrors revenue, and then we have the cash paid out to suppliers and employees, and then interest and taxes paid. Collectively, these mirror the business's expenses. Cash flow from investing activities includes cash outflows from buying investments or other long-term assets, and the cash inflows that come with selling them. Cash flow from financing activities relates to the raising or repaying of cash or capital. There are two ways a business can do this: using liabilities or equity. They can borrow money from a third-party bank, which would increase their liabilities, or a business can look to its owners, its shareholders, who can make capital contributions, which increase equity. On the flip side, they also make loan repayments back to the bank and distribute dividends back to the owners. When we add up the net cash flows from operating, investing, and financing activities, we can reconcile the net increase or decrease in cash back to the movement in the balance sheet. Now, how does the indirect method work? The only section that changes is cash flow from operating activities. We use 3 steps to work it out. The indirect method always begins with the net profit or loss from the income statement. Then in step 2, we add back all the non-cash expenses that appear above it. These don't represent cash outflows and they need to be reversed out. The usual suspects are depreciation and amortization, and any gain or loss on the sale of non-current assets or long-term assets. Finally, we adjust for the movement in working capital. Working capital is the difference between current assets and current liabilities. Increases in current assets like inventory or receivables reduce cash flow, whereas increases in current liabilities like payables increase cash flow. You can find all of these numbers on the comparative balance sheet. Now you're probably thinking that the direct method sounds a lot easier. Why don't we just use that? You're right, it is easier to read, but it's actually harder for accountants to prepare, so we don't use it as much. The indirect method is much easier to work out because we can find a lot of these numbers in the income statement and the balance sheet, as you'll see in this next example. How do we make a cash flow statement? Yes, it's time for that example, and we'll be using the indirect method because it's easier. We'll need a couple of things to get started. First, we need an income statement. Here's one for a business called Tumble, which is a fictional dating app. It summarizes Tumble's revenues and expenses for the year ended December 31st. And here's Tumble's balance sheet, which we made in the balance sheet video. It shows us a snapshot of their assets, liabilities, and equity at the end of the year. But hold on, we're using the indirect method, so we actually need to see last year's balance sheet as well. So this is Tumble's comparative balance sheet. We have the current year one on the left and last year's one on the right. Nice! One more thing before we begin. Here are some key facts which happened during the year. Tumble sold some furniture for $10,000, which originally cost them $20,000 and had been depreciated by $5,000. The loss on the sale was charged to general and admin expenses. Tumble also spent $910,000 on computer equipment. They raised $100,000 in long-term debt and made no repayments. And finally, they issued $50,000 in common stock and paid out $1 million in dividends. Righto, let's begin. What are we reconciling? Cash. This is a cash flow statement after all, so let's head over to Tumble's comparative balance sheet. We can see that they held $13,895,000 in cash at the end of last year, and this number increased to $17 million at the end of this year. So we can lift these numbers and place them at the bottom of our indirect cash flow statement. Overall, that's a net increase in cash of $3,105,000. But how did Tumble pull this off? Let's find out. We'll start with cash flow from operating activities. In step 1, we need to find Tumble's net profit or loss for the current year. That's easy, we can get it from the income statement. On the bottom line, we can see that Tumble earned $9,650,000 this year from their core operations. We'll take Tumble's net profit and put it right at the top of cash flow from operating activities. Step 2, we need to reverse out all of the non-cash expenses. Non-cash expenses appear above the bottom line in the income statement. Some classic examples are depreciation and amortization. These represent the gradual process of writing off long-term assets. They aren't cash flows. This year, Tumble incurred $850,000 in non-cash expenses. So we'll add this back in our cash flow from operating activities. But that's not all. Tumble made a loss on the sale of long-term assets. If we jump back to our key facts page, we said that they sold some furniture for $10,000. So let's quickly do some workings. This furniture originally cost Tumble $20,000, and by the time it was sold, it had incurred $5,000 in depreciation, leaving it with a carrying value of $15,000. Tumble sold this furniture for $10,000, which left them with a loss on the sale of $5,000. This is also a non-cash expense, and it was charged to general and admin expenses in the income statement. We need to reverse it out in our cash flow statement. So we'll add back a loss on the sale of furniture of $5,000. Step 3. We need to adjust for the movement in Tumble's working capital. Working capital is the difference between current assets and current liabilities. Ignoring cash, current assets are typically made up of inventory and receivables, and current liabilities are payables. We can find the movement in all of these on Tumble's comparative balance sheet. It doesn't look like Tumble has any inventory, but they do have some receivables. Accounts receivable, other receivables, and prepaid expenses, which add up to $14,050,000 in the current year, and $8,850,000 last year. That's an increase in receivables of $5.2 million during the year. An increase in receivables reduces cash flow, so we subtract $5.2 million from cash flow from operating activities. I like to think of it this way. If receivables have gone up, then Tumble is owed more money, which isn't good for cash flow. Payables work in a similar way. Tumble has accounts payable, taxes payable, accrued expenses, and some deferred revenue. All of this adds up to $14.4 million in payables in the current year, and last year they had $14,850,000 in payables. That's a year-on-year decrease in payables of $450,000. We subtract decreases in payables under cash flow from operating activities, because if payables go down, then more supplier accounts have been settled, so there's less cash. When we take Tumble's profit, add back their non-cash expenses, and adjust for the movement in working capital, then we can see that they had a net cash inflow of $4,855,000 from operating activities. Next up is cash flow from investing activities. We're done with operating activities, so the rest of the cash flow statement is the same, whether you're using the direct or the indirect method. On our key facts page, we can see that Tumble spent $910,000 on computer equipment. This is a cash outflow from investing activities because they bought long-term assets. But Tumble also sold a long-term asset. Remember that furniture we talked about? Tumble made a loss on its sale, which we called a non-cash expense. We added it back in cash flow from operating activities, but we also need to record the cash receipt on the sale of $10,000. This sale isn't part of Tumble's core business, so we record it as a cash flow from investing activities. When we total it against the purchase of computer equipment, that leaves us with a net cash flow from investing activities of $900,000. This time it's a cash outflow, so the number's negative. Cash flow from financing activities. Financing activities involve raising or repaying cash or capital used to fund a business. On the key facts page, we can see that Tumble raised $100,000 in long-term debt. This is a liability to a third-party bank, and this year they made no debt repayments. They issued $50,000 in common stock, which is a capital contribution from the shareholders who own the business, which increases equity, and they paid $1 million out in dividends back to these shareholders. That would have decreased their equity. We can pull all these numbers through into cash flow from financing activities. Tumble received $100,000 in cash from long-term debt. They raised another $50,000 in equity, and they paid out $1 million in dividends. So that's a net cash outflow from financing activities of $850,000. Almost there. When we total the cash flows from operating activities, investing activities, and financing activities, we can see that Tumble had a net increase in cash of $3,105,000 during the year. This matches the movement in cash that we saw in the balance sheet, so we've reconciled this cash flow statement using the indirect method. Oh yeah! Congratulations! You are now officially an expert on financial statements. I've just decided. The next step is to learn how to read and analyze them. And boy, do I have the video for you. It's right here, and yes, it's on financial ratios. Why not give it a watch? I'll see you there.